Many traders believe success comes from finding the perfect indicator or the perfect strategy. But after decades of studying markets, some of the most experienced traders have reached a different conclusion. The real challenge is not the tool you use. It's how you think, how you react under pressure, and how you manage uncertainty in the market. Welcome back to the ComLucro channel. In this video, we will go through a series of insights from legendary trader Larry Williams, covering topics such as discipline, survival, simplicity and analysis, and how experienced traders actually approach the market. The objective is not to give you another strategy, but to share the principles that guide professional decision-making and help traders stay consistent over the long term. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we begin, it is worth understanding who Larry Williams is and why his perspective matters. Larry Williams is one of the most recognized traders in the world, with more than 5 decades of experience studying financial markets. He is known not only for developing technical indicators such as Williams %R, but also for his research into market cycles, seasonality, and trading psychology. Throughout his career, he has written several influential books, trained professional traders, and won the World Cup Trading Championship in 1987 by turning $10,000 into more than $1 million in a single year. More importantly, Larry Williams has spent decades observing how traders succeed or fail in real market conditions. And many of his most valuable lessons are not about strategies, but about mindset, discipline, and survival in the markets. So let us start with one of his most direct questions. Do you have what it takes to be a trader?
Do you have the right stuff to become a trader or an investor? Frankly, I doubt it. A dear friend of mine, Jim Irwin, was the first astronaut to drive a car on the moon. I asked Jim how he got selected to become an astronaut. What process did they go through? He said the big tests were on how much stress we could handle. And to learn to handle stress, they had to repeat the same function over and over. Things would change. They'd have to learn to respond to it. That's what traders do and investors do. We're always responding to something that we don't have a lot of control over, just like the astronauts. So if you don't handle stress well, if you get emotional, you respond too quickly, this is not for you. Pack up your computer, stop trading, you're going to lose money. I don't want that to happen to you. Or learn to handle stress, to stop, to think before you react. Most people that are not making money react too quickly. Instead of cooling off a little bit, thinking about it, they jump to conclusions. This is not a business where you want to jump to conclusions.
Larry Williams is pointing to one of the most uncomfortable truths about trading. Most people think the challenge is finding the right strategy, but the real challenge is managing yourself under pressure. The market constantly creates situations where your emotions want to take control. When price moves quickly, many traders feel the need to react immediately. They chase trades, close positions too early, or jump into the market without a clear plan. The problem is not the chart. The problem is the speed of the reaction. Professional traders understand that reacting too quickly is often the most expensive mistake you can make. The market rewards patience and punishes impulsive behavior. Learning to pause, evaluate the situation, and act with intention is one of the most valuable skills you can develop. Think about the astronaut example Larry mentioned. Astronauts train for years to operate under extreme pressure. They repeat procedures again and again so that when something unexpected happens, they do not panic. They respond calmly and methodically. Trading works the same way. The market will always create uncertainty. Prices will move in ways you cannot fully control. But you can control your reaction. You can slow down your decisions, follow your process, and avoid the trap of emotional trading. In the end, success in trading is rarely about being the fastest to react. It is about being the most disciplined when everyone else is losing control. Now, Larry Williams explains why perfectionism can become a serious obstacle in trading.
There are some people that just should not try to trade or do serious investing on their own. Because the market is not perfect. There's so much random activity in what I do as a trader or an investor. So if you demand things be exactly your way and you can't handle it if it's not your way, throw away your charts. Just buy a mutual fund and hold on to it forever. You're going to feel so frustrated, and that frustration will cause you to make the wrong decisions in trading or investing. The one thing I absolutely know from all these years of working with thousands of traders throughout the world is perfectionists have the most difficult time becoming successful in the market.
In this clip, the key idea is about expectations and how they affect trading performance. Many people approach the market believing that with the right analysis, they should be able to predict exactly what will happen next. But markets are not perfectly predictable systems. They contain a large amount of randomness and uncertainty. When someone expects everything to behave exactly according to their plan, frustration appears very quickly. A trade that does not work as expected can feel like a personal failure, rather than simply part of the natural uncertainty of markets. That frustration often leads to poor decisions. Traders may abandon their strategy, take revenge trades, or increase their risk in an attempt to quickly recover losses. Ironically, the desire for perfection can become one of the biggest obstacles to consistent performance. The perspective shared here reflects the experience of Larry Williams, who worked with thousands of traders over many years. One pattern he repeatedly observed was that perfectionists tend to struggle because trading requires accepting uncertainty and managing probabilities rather than seeking certainty. Successful traders learn to think differently. They understand that losses are part of the process. Instead of trying to control every outcome, they focus on controlling risk and following their plan over many trades. In the end, trading is not about being right every time. It is about managing uncertainty with discipline. The traders who accept that reality are usually the ones who stay in the game long enough to improve and succeed. Now, Larry Williams explains the most important trait he has seen in successful traders.
I worked with probably 100,000 traders and investors literally throughout the world. My books are in every major language of the world. And I really looked and worked with these traders to see what separates, what makes a really successful winning trader. And you know what I think I've seen in all of these people? They're absolute survivors. Some are not what you would call particularly intelligent. They're not bright. They're not gifted mathematicians. They may have a background like mine in journalism and writing, or they might be a car mechanic. Or they come from all walks of life, but they just have that strong desire to survive. And I don't know quite where that comes from. I don't know quite how to teach that to you or how you can become that, but it's something I think you need to have as a model. It's all about survival, not losing your money, staying in the game, not betting big, so of course you can stay in the game, but you increase your ability to survive and you're going to become a much better trader or investor.
Larry Williams is pointing to one of the most important principles in trading, and that is survival. Many people approach the market thinking that success comes from finding the perfect strategy or predicting every move correctly. But in reality, the traders who last the longest are usually the ones who focus first on protecting their capital. Think about it this way. If you lose most of your account early, even a great strategy cannot help you anymore because you are no longer in the game. Survival in trading means controlling risk, avoiding oversized positions, and accepting that not every opportunity needs to be traded. Another interesting point Larry makes is that successful traders come from all kinds of backgrounds. You do not need to be a mathematician or a financial genius to succeed in the market. What matters much more is discipline, patience, and the determination to keep improving while protecting your capital. Many traders fail not because they lack intelligence, but because they take unnecessary risks. They try to make money too quickly, they bet too large, and they do not respect the possibility of loss. Professional traders, on the other hand, understand that longevity is the real edge. If you can stay in the market long enough, learn from your mistakes, and manage your risk properly, your chances of success increase dramatically. Trading is less about winning one big trade and much more about staying consistent over hundreds of trades. In the end, the mindset Larry describes is simple but powerful. Your first goal as a trader is not to get rich quickly. Your first goal is to survive, because the traders who survive are the ones who eventually learn how to win. Now he shares what he believes is the most valuable book a trader can ever read.
Well, there's 3 books that I really highly recommend to you. The first would be, it's a fun read called Confessions of a Stock Market Operator, supposedly a story about Jesse Livermore. But to really understand the markets and yourself, I would recommend a book called Zurich Axioms. It's been just a wealth of information about how markets work, how about our emotions, how we can handle ourselves better in the marketplace. That's really the best book I've ever read about being a long-term investor and thinker of the markets. But the very, very best book of them all is this one, the one you're going to write. This is my book where I put in my trades every day, so I see if I'm buying and selling. I can look back at my trades and say, oh, what did I do wrong here? What did I say? What was I thinking? Why did I take that trade? That's the best way you're going to become a good trader. Keep records. Look at your successes. Look at your failures. Learn from your successes and your failures. And ladies and gentlemen, that's the best book you'll ever read about the market.
Larry Williams finishes with one of the most powerful lessons a trader can learn, and it has nothing to do with indicators or strategies. It has to do with self-awareness. The trading journal he is talking about is one of the most valuable tools you can have as a trader. Many traders spend years searching for the perfect strategy, but they never study their own behavior. They do not track why they entered a trade, what they were thinking at the moment, or how they managed the position once they were in it. Without that feedback loop, it becomes almost impossible to improve. A trading journal allows you to see patterns in your decisions. You start noticing when you trade too aggressively, when you break your own rules, or when you take trades that do not really fit your plan. At the same time, you also begin to recognize what you are doing right. Over time, this process builds a kind of personal database of experience. You are not just looking at charts anymore. You are studying your own decision-making process. That is where real progress in trading usually comes from. Larry also mentioned 2 classic books, but the most interesting idea is the third one. The best trading book is the one you write yourself. Every trade becomes a lesson. Every mistake becomes a piece of information that can help you improve. If you treat your trading journal seriously, it becomes more than just a record of trades. It becomes a mirror of your discipline, your psychology, and your evolution as a trader. And in the long run, that self-understanding can be far more valuable than any single strategy. Next, Larry Williams explains why too many indicators can actually hurt your trading.
When I look at traders and investors' charts, I say, oh my gosh, not only do you not have the right tools, you have way too many of them on. That's the first error I see most people are making. They have my Williams percent R, and they have stochastic, they have Bollinger percent bands, whatever. It's all saying the same thing. It's so confusing. You have all these indicators in your chart, and the success of this business is about simplicity, not making it complex. So the more indicators you have, the more difficult it is to make a decision.
In this clip, the focus is on one of the most common mistakes traders make when they begin studying the markets. Many believe that adding more indicators will automatically improve their analysis. In reality, most indicators are derived from the same underlying source, which is price. When several indicators are placed on the chart at the same time, they often repeat the same signal in slightly different forms. Instead of adding clarity, this usually creates confusion. When a chart becomes crowded with indicators, decision-making becomes slower and less confident. One tool may suggest buying, another may suggest waiting, and another may suggest selling. That conflict often leads to hesitation and second-guessing. Experienced traders usually move in the opposite direction. Instead of adding more tools, they simplify their charts and focus on understanding price behavior itself. The perspective in this clip reflects the experience of Larry Williams, who spent decades studying markets and developing trading tools. Interestingly, even though he created indicators himself, he often emphasized that simplicity is one of the most powerful advantages a trader can have. A clear and simple framework makes it easier to stay disciplined and follow your trading plan. In many cases, the edge in trading does not come from adding complexity. It comes from removing unnecessary noise and focusing on the information that truly matters. In this clip, Larry Williams walks through the core tools he uses to read the market.
First of all, I want to have something that helps me measure trend. So I could use a 50-day moving average, or I just eyeball a chart, say we're in an uptrend or we're in a downtrend. Not that complex. Then I will have one, what I would call an overbought or oversold index on my chart. I like to use Williams %R. It's a really good indicator to tell you we've been rallying too much, we'll probably pull back, or it's now time to be a buyer because we're in the buy zone. Then I want to have an indicator that measures a professional accumulation coming into the marketplace. That could be on balance volume. It could be my POVI, price open interest in volume, or my Williams accumulation distribution formula. And I want to see when buying is coming into a market supporting price. I also clearly want to look at a seasonal tendency in the market. So I have a seasonal chart, so I can see should my stock or commodity be rallying right now based on the seasonal tendency. Are we weaker or are we stronger now than the seasonal pattern? Obviously that gives me a lot of information about what I should be doing.
Larry Williams is showing a very practical way to think about market analysis. Instead of filling a chart with dozens of indicators, he focuses on a few categories of information that help him understand what the market is doing. First, he wants to identify the trend. This is the basic direction of the market. Are prices generally moving higher or lower? Many traders overcomplicate this step, but the trend can often be recognized simply by observing the structure of the chart or using a basic moving average as a reference. Second, he looks for overbought or oversold conditions. These moments can signal that the market has moved too far in one direction and may be ready for a pullback or reversal. Tools like Williams %R were designed to highlight situations where price may be stretched. Third, he wants to see whether professional money is supporting the move. Indicators related to volume or accumulation attempt to show whether larger participants are entering the market. When buying pressure appears together with a trend, it can strengthen the signal. Finally, he considers seasonality. Some markets behave differently depending on the time of year. Commodities, for example, often move in cycles related to production, demand, or economic patterns. Looking at seasonal tendencies can add useful context to current price movement. What is interesting here is how his analysis is structured. Each tool answers a different question. What is the trend? Is the market stretched? Is professional money participating? And does the seasonal pattern support the move? When analysis is organized in this way, trading becomes less about random signals and more about building a clear framework for decision-making. Here, Larry Williams explains a simple way to identify the market trend.
How do you know if the trend of your stock or commodity is up or down or sideways? There is a mathematical way of telling it. I'd like to share that with you today. There's so many ways of looking at trend, but the simple one I developed years ago, and you can put it on all of the software you have, is simply a 50-day moving average. If price is above a 50-day moving average, or that 50-day moving average is an uptrend, assume that the trend is up. If it's in a downtrend, then assume the trend is down. In a downtrend, that means you would want to be taking short-term sell signals. In an uptrend, you can take all the buy signals because then you will be trading and you'll be investing with the trend. The trend is your friend. Stay with it, use a 50-day moving average, and you'll know the real trend of the market.
Larry Williams is highlighting a principle that has guided traders for decades. The idea is simple. Trading in the direction of the trend dramatically increases your probability of success. Many traders focus too much on trying to predict reversals. They want to catch the exact top or the exact bottom of a move. While that might sound attractive, it is often one of the fastest ways to lose money in the market. Fighting the dominant trend usually means trading against the flow of larger market participants. That is why trend filters exist. Tools like moving averages are not designed to predict the future. They are designed to help you stay aligned with what the market is already doing. When price is consistently above a rising moving average, the market is showing strength. When it is below a falling average, the market is showing weakness. Even though Larry mentions a simple 50-day moving average, the real lesson is about structure and direction. Before looking for entries, traders should first ask a very basic question. What is the dominant direction of the market? Once that direction is clear, decisions become easier. Instead of trying to trade every signal in both directions, you focus on opportunities that align with the trend. That alone can eliminate many low-quality trades. Simplicity is often a powerful advantage in trading. A clear understanding of trend can help you filter signals, stay disciplined, and avoid unnecessary trades. And as Larry reminds us, one of the oldest sayings in trading still holds true today. The trend is your friend. Next, Larry Williams demonstrates a chart pattern he has used successfully for years.
For the most part, price activity on charts is very random. It really doesn't represent much of anything other than trend, and a few patterns that I found in my over 50 years of trading can be very successful. Let me teach you one right now. If I've seen prices in a big downtrend, they move sideways and drop, but immediately come back up, back into that trading range, that's a buy signal. Why? Because during that trading range, there was accumulation going on. The fact that it broke down fills a lot of long positions. Professional money will buy there. And if it immediately comes back, then that nails it. They've been buying, and I want to get long the market. So be careful. I don't want you to lose your money in Wall Street. There are some good patterns, but use them selectively.
In this clip, the key idea is not just the pattern itself, but what the pattern reveals about market behavior. When price breaks below a range and quickly returns back inside it, something important is happening beneath the surface of the chart. During that breakdown, many traders panic. Long positions get stopped out, and breakout traders often enter expecting a continuation lower. That sudden wave of selling creates liquidity in the market. If price immediately reverses and climbs back into the range, it suggests that stronger buyers were waiting for that liquidity. This type of movement often signals that the breakdown was not genuine selling pressure. Instead, it may have been a temporary move that allowed larger participants to accumulate positions at better prices. This is where experience in chart reading becomes important. Markets do not always move in straight lines, and many apparent breakouts fail. When they fail quickly, they can reveal where the real buying interest is located. The idea explained in this clip comes from Larry Williams, who spent decades studying price behavior and identifying patterns that repeat across markets. One of his key lessons is that patterns should not be traded mechanically. They should be understood within the broader context of how markets behave. In the end, the real edge is not simply recognizing a pattern. It is understanding the story that price is telling about liquidity, pressure, and the actions of other traders in the market. In this clip, Larry Williams reveals a cycle he believes drives many market moves.
I'm going to give you my secret of short-term and intermediate-term cycles right here, right now. It's a 13-week cycle. Why 13 weeks? Some magic number? No. What happens every 13 weeks in the stock market? Companies report their earnings. So because of that, there's a real strong, dominant, natural cycle of about 13 weeks in the Dow Jones Industrial Average, the S&P 500. In fact, most all stocks, especially ones with dividends. So you need to look at your stock, your investment program, versus the 13-week cycle. Most software will let you put that on your chart, or just look at it yourself. About every 13 weeks, these stocks start substantial moves. Pay attention to the 13-week cycle.
Information often changes expectations, and expectations are what drive price movements. Because of this, markets can naturally develop rhythms around these reporting periods. Traders and investors adjust their positions ahead of earnings. Institutions rebalance portfolios, and new information reshapes sentiment across the market. Larry Williams spent decades studying these recurring patterns and noticed that significant moves often develop around this quarterly rhythm. The idea is not that the market will always turn exactly on a specific week, but that the flow of information tends to cluster around these cycles. For traders, this perspective can be useful because it adds another layer of context. Instead of looking only at the chart in isolation, you begin to consider when important information is likely to enter the market. In other words, timing in the market is not only about price levels. It can also be influenced by the calendar and by the economic events that repeat over time. Understanding those cycles can help traders anticipate periods when volatility and directional moves are more likely to appear. Here, Larry Williams explains why patience is essential for day traders.
Day traders think they can make money every single day. They can't. Some days are much better to have a big trend move than others. So how do you know when you're going to have a large trend move? Because that's the only way that a short-term trader will make money. So when do those days occur? I'll tell you when. When we've had a series of 1 or 2 days with small ranges, then we're going to have large ranges because the markets move in a natural cycle, small ranges to large ranges. So when I'm day trading, I sit back, I wait until I've seen a series of small ranges, because then I know I'm going to have a large range, an explosive range. Large ranges don't attract me to day trading. They do most day traders and they end up losing because then we go into small ranges. To be a successful day trader, use patience, wait until you see small ranges because that's when your best opportunities are going to come.
In this clip, the focus is on volatility and how market ranges tend to expand and contract over time. Markets rarely stay in the same condition for long. Periods of quiet trading are often followed by periods of expansion where price begins to move more aggressively. This alternating behavior between small ranges and large ranges is something many experienced traders pay close attention to. When the market becomes very quiet and ranges begin to compress, it often signals that energy is building. Eventually, that compression releases, and price can move quickly in one direction. Many day traders make the mistake of doing the opposite. They become excited after a large move has already happened and try to jump into the market late. At that point, volatility often begins to contract again, which makes it much harder to capture meaningful moves. The idea discussed here comes from Larry Williams, who spent decades studying the rhythm of markets and how volatility tends to cycle. His observation is that patience is one of the most important advantages a trader can have. Instead of forcing trades every day, successful traders learn to wait for the right market conditions. When ranges have been small for several sessions, the probability of expansion begins to increase. That is when opportunities for stronger moves can start to appear. In many ways, trading is not only about direction, but also about timing. Recognizing when the market is quiet and when it is likely to become active can help traders focus their attention on the moments when the best opportunities are most likely to develop. Now, Larry Williams explains where most trading profits actually come from.
Day traders have it all wrong. They see the market run up, they sell it. It comes down, they buy it. It runs up, they sell it. It comes down, they buy it. It runs up, they sell it. And then, whoa, prices take off and they sell and they lose money all the way up, not realizing the only way you make money in the market is to catch a trend. It doesn't matter if you're a day trader or a long-term trend trader. Trend is the basis of all profits. You need a trend. Now, we also know this, if you study your charts, you'll see that all large range days, or almost all of them, close at their high or close at the low. So the most successful day trading strategy is to hold to the close. Don't try to dance in and out, because when you have a loss, you're going to have a big loss. Try to catch a trend move, hold to the close, and you're going to make a lot more money. You'll become a successful day trader.
In this clip, the key idea is about how profits in trading are actually generated. Many traders focus on trying to capture small movements again and again throughout the day. They buy a dip, sell a rally, and repeat that process constantly. The problem is that this approach often causes them to miss the biggest moves in the market. Large profits usually come from trends. When a market begins to move strongly in one direction, that move can continue much longer than most traders expect. But if someone is constantly jumping in and out of the market, they often exit the trade before the real move develops. This is why patience inside a trade can be just as important as patience before entering it. Once a strong directional move begins, staying with the trend can allow the trade to capture a much larger portion of the move. The idea discussed here comes from Larry Williams, who spent decades analyzing how markets behave during strong trend days. One observation he made is that large range days often close near the extremes of the session. When that happens, it suggests strong momentum that continues pushing price in the same direction until the end of the day. Instead of trying to capture every small fluctuation, traders can sometimes benefit more from identifying a strong directional move and allowing the trade to develop. In many cases, trading success is less about activity and more about restraint. The ability to hold a good position while the market is trending can often make the difference between small gains and meaningful profits. In this clip, Larry Williams shares a warning about relying too much on financial news.
You really have to be careful what you read. I don't read the Wall Street Journal. First of all, a lot of times they report stories in the Wall Street Journal that are kind of a jinx, how good the company looks and the company falls apart. What I trade is what's right in front of me in my charts and the data that I look at. There are just so many stories, whether it's the Wall Street Journal or Forbes or any of the media, that get us off track of being a real long-term investor or even a short-term trader. So be careful what you read. There's a lot of stories out there that are, well, they're written for a purpose to get people like you and me to buy when we should be selling.
In this clip, the main lesson is about separating market information from market noise. Financial media can be useful for understanding what is happening in the economy, but it can also influence traders in ways that are not always helpful for decision-making. Many headlines are written after a move has already happened. When prices rise, the news often explains why the market is strong. When prices fall, the headlines suddenly focus on the negative reasons behind the drop. For traders, this can create a dangerous feedback loop where decisions are based on stories rather than on the actual behavior of price. Experienced traders often focus more on what the market is doing rather than what people are saying about the market. Price itself reflects the collective decisions of thousands of participants, including institutions, funds, and professional traders. The perspective discussed here reflects a long-standing approach used by Larry Williams. Instead of relying heavily on narratives or opinions from the media, he preferred to analyze charts, data, and the structure of the market itself. That does not mean information has no value, but it does mean traders need to be careful about how much influence headlines have on their decisions. Markets often move ahead of the news, not after it. In the end, one of the most important skills a trader can develop is the ability to filter information. By focusing on objective data and price behavior, traders can avoid being pulled into stories that may distract them from what the market is actually doing. Throughout this video, Larry Williams shared lessons that go far beyond any single strategy or indicator. Discipline, patience, survival, and clarity in decision-making are the foundations that allow traders to stay in the market long enough to truly improve. Markets will always be uncertain, and no system will ever remove that uncertainty completely. But traders who learn to manage risk, simplify their analysis, and control their reactions place themselves in a much stronger position over the long run. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.